Hey everyone, today I want to talk to you about how Interactive Brokers calculates their fees. And I think this is going to be an interesting video, whether you have an Interactive Brokers account or don't even know what Interactive Brokers is. And that's because there are a lot of lessons we can take away from this and apply it to a lot of different places in investing. It's going to be very unique. But don't just take my word for it. Let me prove it to you. To start, I'm going to talk about why I'm creating this video, which is pretty much an extension of a video we made not too long ago called Exposing Interactive Brokers, where I dove into the different types of transaction histories that Interactive Brokers is producing, and how if you were a client, you would want one of those transaction histories. And if you were an investment manager, you'd want another different transaction history, and how Interactive Brokers wasn't making that distinction. They were doing it inappropriately, in my opinion. And from that video, we got a comment from our friend Adam Mead over at the Oracle's Classroom saying that while he was watching the video, one thought occurred to him, and that was, what effect does this difference in transaction history have on how they calculate client fees? So if you're an investment manager, you typically charge fees to your clients to manage the investments. And are they drawing from inappropriate transaction history? And that's where we're going to dive into today. First, with a couple of brief notes that I have to make. First of which is that since the 8 or 9 days I've made that last video, Interactive Brokers has since changed their website, just because that's how my luck is. So you're not going to find everything in the last video in the same order or the same web page that you did if you were to pull it up today. And I think that's a good lesson for us to just talk about now, because for those people that are going to be watching in the future or far future, things will change. But I think the concepts are going to be very important for you to understand and apply going forward. Additionally, I just want to say that this document is listed in the description if you want to follow along, or if you want to check my math or anything like this. Speaking of, the description will also have any corrections that I have to make, as will the comment section if I have to spill over. So please make sure to check those before ending your time watching this video. And lastly, I will check and see if anyone has questions, but only at the very end. I'll do my best to answer everyone's questions. But let's get into it by starting with how we're going to set up this client fee so you can kind of follow along. So let's pretend you and I are partners in an investing firm. So we're going to invest money for a client, and we're going to collect a fee for our services. And the way we want to charge our fee is based on assets under management. And we're not just going to do a straight fee. We're going to separate it in divisions. So that way, if a client puts more money with us, then they can be charged the lower fee. So they can be incentivized to give us a lot of money so we can make more money. So let's pretend we decided that we wanted our fee structure to be progressive like this. And what I mean by progressive is, imagine our client had $150 for us to invest. Well, the first $100 is going to be charged 3% annualized rate, and the remaining $50 is going to fit into this bracket at a 2% annualized rate. And this is kind of how Interactive Brokers, I guess you could, there are other ways to charge, but this is how we're going to go along with our example here. This is how Interactive Brokers is going to break down these divisions, except with one crucial detail that I need to mention, and that is they're not going to charge $100 times 3%. They're actually going to find a daily equivalent by taking the 3% and dividing by 252 days in a year. Why 252? We'll get to that in a second, but I just need you to know that's how they calculate it. So down here, I have two examples, as if a client had $200 or $2,000. You can read the $2,000 one. I'm going to walk you through the $200 one for now. So let's imagine a client had $200 in our firm. Well, like we said earlier, the first $100 is going to be charged at 3% annualized, but we need to divide that by 252 to find a daily equivalent. And then the remaining $100 is going to be charged at 2% divided by 252. Now, that's going to be how much fee is accrued every day. If our balance goes up or down, we need to do that every single day and kind of accrue this massive fee that at the end of a month or a quarter, whatever the investment manager decides, we're going to charge to the client. So it accrues for however long, and we base it on the daily balance that we record every single day, and then we're going to charge the fee at the very end. So that's how they do it. which begs two questions. The first of which is, why 252 days in a year? And the second question is, how are they calculating that daily balance? Are they using, the inappropriate transaction history that Adam said may or may not have? He wasn't alluding to it or anything. He was just saying it would be interesting to know if they were using a one that was not as favorable to the client, or if they were using one that was more favorable to the client. And that's what we're going to dive into with a few other things. So first, 252. So the reason why Interactive Brokers is using 252 as their daily equivalent, when you and I would probably expect 365 or 66 in a leap year, is because 252 is the amount of days on average the stock market's open in any given year. I think the practice is distasteful. And here's why. Imagine putting your money into a brokerage, like you just open up a Vanguard and you just put in $100 on Friday morning. Now, Friday morning all Friday goes by, Saturday goes by, Sunday goes by, and then Monday goes by, and you end up selling. So from Friday morning to Monday night. In my eyes, that is a 4-day period, because that's exactly what happened. Friday, Saturday, Sunday, Monday. But Interactive Brokers and many other people like to refer or relate things to the 2 days that the stock market was actionable, that money was actionable in that brokerage. Now, the easiest way for you to understand my argument as to why that's 4 days and not 2 days is using my zoom in, zoom out mental model, and really the zoom out portion of it. And let's imagine you had $200 and you put $100 in a stock that was in the New York Stock Exchange and $100 into a stock that was in the Hong Kong Stock Exchange. Now let's imagine, just for the New York Stock Exchange for a second, that the stock exchange, as soon as you put money in, shut down. And it remained shut down for 10 years. You couldn't see anything that happened to it. All you can see is that you put in money on that day, and in 10 years, you got to see the ending balance, which we'll say was 1,000% gain. The Hong Kong Stock Exchange, however, the stock you put in the Hong Kong Stock Exchange, however, remained open and gradually increased at the same rate all the way for 10 years. Now, let's just say we're 10 years into the future now, and we're looking at, we're trying to compare the performances of those two stocks. According to kind of this fundamental way that Interactive Brokers is using 252 days, you might be tempted to say that that's a 1,000% gain over 2 days that the stock market was open. It's not wrong. It's a different perspective, but I don't think it's a very useful perspective, especially when you might be tempted to say, you might be tempted to compare those 2 days that it was open and 1,000% gain to 2 days where the Hong Kong Stock Exchange was open. That's not a fair equivalent. The first thing that we should do in our mind is find a fair equivalent, which might be like an annualized rate, and then compare to see which opportunity did better for you. So it's not that, again, 252 days is wrong. I just think it's sloppy and based on poor framework. So just really interesting that they use 252 here, and I've seen it done countless other times. If I could put a nail in that coffin, I would, but we'll move on. So that's the 252. Now let's talk about how Interactive Brokers calculates the daily balance. So the first thing you need to know is that the daily balance is based on an accrual basis. And all that means is when you invest, sometimes money is going to be owed to you, or you're going to owe money, but you don't have to pay it, or it's not paid to you just yet. For example, if you're invested in a company and it decides to give you a dividend, there's a brief period where they say, okay, we owe you a dividend, but it hasn't been paid to you yet. It takes some time for the money to reach you. What Interactive Brokers does is in that time, it says, well, you're going to receive your dividend. So we're going to say that your net worth increased by that much. Dividends might not be the only thing either. You can also include like ADR fees. An ADR fee is like if you own stock in a company in like the Hong Kong Stock Exchange, just to use the example from before, through an ADR, you might be charged a fee for that service. So there might be a brief period where you haven't paid the fee, but you owe it. And it's going to take some time. So Interactive Brokers changes your net worth based upon that. Now, Personally, I don't like this method, and I think that's a big topic and for another time. But the best way for me to sum it up now is by zooming out again and kind of taking everything to the extreme and asking you if you'd rather have $1 million today or $1 million in 1 year. According to the accrual basis, the net worth of both opportunities are the same, right? Because in the first opportunity, you get $1 million now. And in the second opportunity, you don't have $1 million, but you're owed the $1 million. So you will receive $1 million. So your net worth is $1 million. I beg to differ. I think it's misconstruing the time value of money. In my eyes, the first opportunity has $1 million net worth, and the second opportunity has a $0 net worth until 1 year. Then it has $1 million net worth, and there's a big distinction to make. But again, that's too much for now. It's just something I need you to know. It's based off the accrual basis. And lastly, to answer Adam's question, what transaction history are they using to calculate the balance? And they're actually not using the reports transaction history, which would be used by the managers according to our last video that we talked about. And it's not using the statements one that clients would use to calculate their returns. They're using a third transaction history, which is actually very close to the reports one. Now, if we were to kind of create the ideal scenario for our client, we would want it to more closely mirror the reports section for our clients. And I'll talk about that in a second. So that's kind of a good thing. But let's look and see the comparison between what you see on the dashboard, which is this Bravo, or I'm sorry, got to speak in normal person terms, not air traffic terms, this column B here, or the column D here. So column B is what you see on the dashboard. It's where you go performance on reports, portfolio analyst, and this is kind of how you track your balance. And this is the balance that the fee is using, which you find in advisory client fee invoice or something. I think that's what it's called. I have it listed down below. So you can see on these red highlighted days, the fee used in the balance is higher than what we're seeing when we look at the reports transaction history or the overview dashboard. So if it's highlighted in red, that's the case. If it's highlighted in green, it's actually the opposite, where what we're seeing on the overview, or if the clients were having a fee based on the report section, were more favorable to them. So if I were to extrapolate and pull out the transaction history that the fee is using or the report section is using, this is the table that we get. So what you can see is that it's got 4 different transactions essentially. There's a $3,600 deposit here. There is a $118.35 here, $81.65 here, and $200 here. 2 of the 4 scenarios matched up perfectly. It's these 2 scenarios, the $3,600 and the $81.65, that are kind of off. Now, my conclusion to all of this here is that 1, Interactive Brokers is using a third kind of secret transaction history to calculate the fee. There's no transaction history that you can pull up, no statement or report or whatever you want to call it, no document showing you the fee transaction history. You kind of have to do the math and figure it out yourself. And 2, the second conclusion I have here, by looking at what we're seeing here, it almost seems like a timing issue. So notice that like the reports show you the beginning of the day history and the fee shows you the end of the day. So let's pretend $3,600 came into Interactive Brokers at like 5 p.m. Would you say that's the end of the day? I'm sorry, 5 p.m. on April 27th. Would you say that's end of the day, April 27th? Or would you say that's the beginning of the day in April 28th, like the beginning of the business day? So there's probably some kind of discrepancy here. And, maybe this amount of money didn't settle until the middle. In order for me to say for certain, I would need to know the exact time that the money settled. And I don't think I have that information. So that's kind of my hunch. And like we said earlier, and this is conclusion number 3 here, we would want the clients to be charged based on the reports history, not the statements history. And this is really close to the reports history. So what they're doing is more favorable to the client, which is okay by us. However, because they're using this third transaction history rather than the reports transaction history, you can see that my client did get charged about 8 cents higher than they should have. But keep in mind that this kind of quarter, I charge quarterly, was cut short because of the way I set it up later in the year and stuff like this. So it's only 2 months rather than 4 months. And keep in mind that, this is only 1/4 out of 3/4 of the year. And also that these are small sums of money. So just something to keep in mind um, for people that are trying to analyze uh, client fees when it comes to interactive brokers. So that's pretty much what I wanted to talk about here, the 3 big ideas, as well as kind of telling people to really be cognizant of the authority bias. A lot of people, when they see like interactive brokers, they think, oh, that's a large established institution, but there may be a lot of things they're doing wrong. I don't really see too many terrible things here. I just see things that are really interesting to me, like the choice, to make 2 different transactions here, or why use 252, which I think is fundamentally flawed, and stuff like this. But I think it's really interesting for you to know, and it also helps keep a larger margin of safety and an understanding of how things are working. So that's all I have for you in this video. I'm just going to see if anyone's got questions. Nobody has questions, so I think I'm going to end the broadcast. So thank you so much for watching, and until next time.